What's up? What's up? Okay. What's good? Um, welcome, guys. Welcome. Let's share the link. Let's share the link. It's exactly 7:30. We're to start at 7:30. It's exactly 7:30. Guys, this shit is not easy, eh? Look at the way I'm sweating. I have to change location from office to home, from the house to a different location. Ah, it's crazy. But anyways, we are here now, guys. Let's inform your friends. Inform your friends. Let them know that we are live. Inform your friends. Let them know we are live. Those who just joined today, please try as much as possible to go through the session for yesterday. The link was sent on Telegram. The link for yesterday's class was sent on Telegram. Those who just joined today, please try as much as possible to go through the recordings. Those who are just joining today, please try as much as possible to go through the recordings for yesterday. Oh, what the fuck? So on this moto. I will let me move away this moto. Front. I park outside. Let's go, guys. Let's go. So while we are waiting on others to join, let's just flash through what we did yesterday. Please make sure you subscribe to the YouTube channel. Please subscribe to the YouTube channel. Have we shared the YouTube link? Because that's what I'm doing now. I'm sharing the YouTube link. Remember, always share. Don't miss out. Always share. Don't let other people miss out. Perfect. Oh, we have all shared. Okay, so we have 580 people on the live stream. So we are good to start while the others will be joining. So good evening to you all. I hope the class for yesterday was well understood. Yesterday we looked at lesson 1, what is Forex trading, why we trade Forex, and where we trade Forex. We looked at lesson 2, Forex pairs and other commodities traded in the market. And the main goal for yesterday was for you to understand the basic concept of what is Forex trading, why you should trade Forex, and where we actually trade Forex. And you also should understand what we trade in the forex market, right? So today we are going to be going to lesson 3, key concepts in forex trading. Key concepts in forex trading. We'll look at lesson 3, key concepts in forex trading, and we'll look at lesson 4, the forex price code. So we are going to look at lesson 3 and lesson 4. And for lesson 3 and lesson 4, our main aim, lesson 3, is for you to understand some key concepts, some key terms in forex trading. Lot, leverage, spread, take profit, stop loss. You might have been hearing all of these things and it's confusing you as a beginner, right? We are going to be looking at all of these key concepts, if not all, majority of the key concepts. With time now, as we get into the session, you'll be hearing new other key concepts, right? And you get to get familiar with those key concepts. So for today, we are going to look at the major key concepts, and we are going to look at lesson 4. Lesson 4, the forex price code, is simply breaking down the forex space, how the base currency and the code currency works, how the pairs work together. Because remember from our session yesterday, we said we don't trade currencies, we trade currencies in pairs, right? So we are going to be breaking down this pair. So we have two pairs, GBP USD. This chart, on the chart, if the chart is buying or the chart is selling, does it mean that it is GBP that is buying or it is USD that is selling, right? We are going to understand all of that. So that's our target for today. If we can end this session and everybody is able to understand these few key concepts, then I'll say we are good to go, right? I'll say we are on track. So let's go right in to lesson 3. Key concepts in forex trading. Key concepts in forex trading. The number here is too small. I don't want to start and they come after. I don't want to start and later on they come and start asking questions. Okay, let's go. Hopefully the others join soon. So we are starting with lesson 3. How many people are new? Those who are new, like you just came in today. Those who are new, you just came in today, drop fire. Those who are new, you just came in today. Let me see those who are new. Yeah, probably the issue of light, because I don't even have light in the office. It's really strange. Okay, those who are new, for the sake of those who are new, right? Let me just use 5 minutes to flash through what we did yesterday. 5 minutes. But you still have to go through the recordings because I see a lot of you as new, right? You still have to go through the recordings of yesterday. So yesterday we studied what is forex trading. We said it's the simultaneous buying of one currency and selling of another, right? Simultaneously, you are buying one currency and selling another. We gave local examples. For example, if you want to travel to the US, you have to change your CFA and get United States dollars. That is you doing exchange. You get. So the word simultaneously there is very important because it must always be two different currencies coming together. It must always be two currencies involved. One is selling and buying another, or buying and selling another simultaneously. You said the forex market is the largest financial market in the world. We're earning about $6.6 trillion a day, right? And it has its advantages. We went ahead to why you should trade forex. Under why you should trade forex, we have easy to access. You can trade the forex market anywhere you are in the world, as long as you have a phone, an internet connection, or a laptop and internet connection, you can access the forex market. We look at transaction cost. For you to be able to trade, you don't need any huge amount of money. You don't need to pay anybody any huge amount of money to access the market, right? You just need to go create a broker with a recommended broker that whoever is going to give you, and you are done. You're creating your account. You're not going to pay any huge amount, right? So the transaction cost in general to actually get into this particular high income skill, to actually get into this industry, is very low. We look at liquidity. When you hear of liquidity, think of money, right? When you hear of liquidity, think of money. So when we say the liquidity is a very important point in the foreign exchange market, we say that because it is the largest financial market in the world, meaning that it has money. Liquidity is money. It has money. And what is the use of this money? The use of this money helps to push the market either up or down, up or down. If you look at the chart, let me show you. Let me just go to the chart. Let me just share my chart for a second, right? I'll just share my chart for a second right here. Because I just saw a question on liquidity, so I want to emphasize on that. I just saw a question on liquidity. Okay, pay attention to the chart right here. So this is my chart right here, right? You see this movement on this chart. The market is moving from here. It comes up. The market moves back. It goes down. From here, it goes down, right? This movement, the market is moving up and down, up and down. This movement, right? This movement is due to liquidity in the market. So if this movement does not occur, you don't make profit. If this movement does not occur, you don't make profit. So let's say you took a buy trade at this point down here. Let's say you took a buy trade here, right? Let's say we took a buy trade here. Now, for you to make profit, the market has to move and go up. If it doesn't move and go up, then you are not going to make profit. What helps the market to move and go up? The liquidity, the money that is circulating in the market. You get? That's what causes the market to go up and come back down. So that's why, under reasons why we should trade forex, we have one of the points being liquidity. You get? That liquidity helps in pushing the market up and down, giving you the opportunities to get in, buy. If you buy, you make profit. If you sell, you make profit. You get? That's the important point on liquidity. We look at leverage. We are going to be looking at leverage today, detailing under this lesson 3, right? We said leverage helps. It's like the brokers giving you capital, right? Borrowed capital. It increases your buying power in the market. So leverage in forex trading is an advantage. That's why we have it under why you should trade forex. That's section 2, section B or section 2 of lesson 1, right? Why we should trade forex. So we have leverage, then we have trading hours. The forex market is open 24 hours a day, 5 days a week. So no matter the time, you can still trade. As we speak now, the market is open, right? Midnight, the market is going to be open. Breaking tomorrow morning, the market will be open. During the day, of course, the market is going to be open. You get? So you can trade anytime, make profit anytime, and you are good to go, right? The last point we gave was trading other commodities. Aside from the forex currency pairs, you are able to trade other commodities. You get? Aside from the forex currency pairs, you are able to trade other commodities. These other commodities we are talking about: gold, it could be metals, it could be indices, it could be cryptos. You name a few, right? So you can choose any of these commodities and you trade aside from the forex currency pairs. Now we went out to lesson 2. What do we actually trade in the forex market? We look at the different currencies. We have 8 different currencies, and these different currencies, when paired together, right, gives us 28 currency pairs. 8 currencies when paired together, mixed together, right, paired together in tools, give us 28 currency pairs. Within these 28 currency pairs, we have major pairs and minor pairs. We have 7 major pairs and 21 minor pairs within that 28 currency pair, that if we mix up the 8 currency pairs, they are going to give us, right? So the 7 major currency pairs, major pairs are pairs that have USD. They are the most traded. They are the most volatile, and they have tight spreads. Those are some of the characteristics we get on the major currencies, right? And I explained major currencies have USD. I explained why they have the most liquidity and why they are the most traded. Make sure you go and watch that video if you are still new, right? This is just to give you a hint, so that when we get to today's session, at least you are able to understand what we did yesterday, right? So the major currency pairs have given some of the characteristics, and there are 7 of them. You can go and you watch through the videos for yesterday. You're going to see all the 7 currencies we gave it out. The 21 currency pairs, we have 21 minor currency pairs. We gave a few, I think about 8 or 9, right, of the minor pairs, but we have 21 of them. Aside from the major and the minor currency pair, we have another category, which is the exotic pairs. Most of the times we don't trade it. In short, it's very difficult to see somebody trading the exotic pairs, right? But the exotic pairs are pairs where currencies of developed countries are paired with currencies of developing countries. I give an example to our country, Cameroon. If you pair CFA to USD, that's an exotic pair, right? XOF or XAF USD, that's an exotic pair. We gave, I think, 2 or 3 examples. We go ahead, aside from the currency pairs, major, minor, and exotic, we have other commodities. Metals, we gave example, silver, you can trade silver, you can trade gold. Indices, we gave example, you can trade US 30, US 100, S&P 500, and many others. Stocks, you can trade Apple, you can trade Amazon, and many others. BTC or crypto, you can trade Bitcoin, that is BTC USD. You can trade Ethereum, that is ETH USD. You can trade Litecoin and many others, right? So that's where we ended for yesterday. Lesson 1 and lesson 2. What is forex trading? Why we trade forex? Where we trade forex? Lesson 2. What do we actually trade in the forex market? So now let's get now to lesson 3. Key concepts in forex trading. Key concepts in forex trading. There's actually one thing I'm lacking on this computer, which is I need something like the studio, which I'll be illustrating. I used to have that on Zoom. Shit. Let me see. I can do that. Okay, I'll use Zoom. I'm just going to go to Zoom now. Is it going to be possible? Okay. Okay. Please just let me know. Can you hear me clearly? Can you guys hear me clearly? Can you guys hear me clearly? Okay. I want to share my screen. Just let me know if you can see my screen, right? Just let me know if you can see my screen. I want to share my screen now. Okay, I want to share this chat. Okay. Okay, let me know if you can see my chat. Can you see my chat? Not yet. Good. Okay. So we can see my chat, right? Then I think we are on point. Okay, now one last test. Can you see what I'm writing on this screen? One last test. Can you see what I write on the screen? You see what I write on the screen? Perfect. Then we are good. We are good to go. Okay. Thank you, guys. Okay, let's continue. So we are going to start with key concept. And the first key concept I want us to look at is PIP. 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 The first key concept I want us to look at is PIP. Key concepts in forex trading. The first key concept I want us to look at is PIP. Yeah, PIP. What is a pip? Let's take down the notes. Pip is the smallest unit of measurement when trading currencies. I like to break it down. So I might give you like, okay, maybe the professional term, then I'll break it down in simple terms. Pip is the smallest unit of measurement when trading currencies. Pip is the smallest unit of measurement when trading currencies. Now I'll give you in simple terms. Take this down. It is used to determine the distance of market movement on the chart. It is used to determine the distance of market movement on the chart. Pip. It is used to determine the distance of market movement on the chart. It is used to determine the distance of market movement on the chart. I'll take it one last time. A pip is the smallest unit of measurement when trading currencies. It is used to determine the distance of market movement on the chart. Perfect. And I'll explain. Now, like I said yesterday, in this market, what we are actually learning here is all about knowing when to buy in the market or when to sell in the market. That's all. When to buy and when to sell. You get? Now, if we are buying or if we are selling, how do we measure the distance the market has moved on the chart? Because we can buy and it buys very far. We could sell and it sells for just a short period of time. The signal I gave today, the signal went to about 100 pips in profit. Now, if I gave an update that 100 pips in profit or 30 pips in profit, what does that mean? What it simply means is that I am saying that the market has moved from this level to maybe this certain level and it has moved 50 pips. They seem like, okay, maybe you want to measure the distance from Douala to Bonaberry. Oh, sorry, from Lokpom to Bonaberry, right? From Lokpom to Bonaberry, from this location to that location, you either measure in kilometers or in miles. You get? Now, within that distance, you are measuring, it might be 10 kilometers, it might be 20 kilometers, it might be 30 kilometers. You get? Within that distance. Same as on the chart. While the chart is moving, we are able to measure how many pips. So instead of kilometers, we use on a normal distance or miles. On the chart, we calculate in pips. How many pips has the market moved from here to here? Or how many pips has the market moved from here to here? You get? So the pip, in simple terms, it is used to measure the movement or the length the market has covered on the chart, anyhow you put it, right? As simple as possible. You get? So it is used to cover the distance or to determine the distance the chart has actually moved. Price has actually moved. You get? So if price move from here now, this is where price is now. Price has moved from here. This is present market price. This is where price is now. This is present market price here. So you see that price has moved from here to up here, right? Now you look, how many pips has the market moved from here to up here? There's a way of calculating it. We'll do that when we get to technical analysis. I don't want to get deep. If I get deep, you start getting confused. There's a way of calculating if the market has moved from here to here, how many pips has it moved? We can just say, okay, maybe the market has moved 10 pips. You see that? So we are going to use this just for example, right? The market has not moved but 10 pips here, but we are just going to use for example, if the market move from here, point A to point B, we'll consider the market has moved from here to up here 10 pips. If it was distance on ground, we'll probably calculate maybe in kilometers. But it is on the chart, we are calculating in pips. Right? So we are using 10 pips. So that is a pip. So what is a pip? If I'm to ask you, what is a pip? Don't bother giving me, it's the smallest unit of measurement. It's simple. Have you understood what is a pip? It is used to measure the distance the chart, the market has moved, covered, or price has covered on the chart. It is used, what was the definition I gave again? It is used to determine the distance of market movement on the chart. It is used to determine the distance price has moved on the chart, right? Just understand, like really understand the concept. You get the point. Now, let's get to the next key concept. Have we all understood what is a pip? Have you understood what is a pip? Are we all clear on what is a pip? Perfect. Now let's get to the next key concept. Lot size. Lot. L-O-T. Lot. Lot size. The next key concept, lot size. Lot size. Thank you. Let's go back to our pens. Let's go back to our books. Lot size. What is lot size? Let's take the definition. Lot size refers to the number of currency unit. Lot size refers to the number of currency unit being traded in a forex position. Like I said earlier, I'll give you kind of like the professional or the big terms kind of definition, then I'll break it down, right? A lot size refers to the number of currency unit being traded in a forex position. A lot size refers to the number of currency unit being traded in a forex position. Full stop. Or, let me give you in simple terms now. Or, it is used to measure the size of your trade. Or, it is used to measure the size of your trade. Or, it is used to measure the size of your trade. The size of your trade. It is used to measure the size of your trade. Now, you saw the screenshots I posted today. A lot of people made profit, right? But if you look at those screenshots detailedly, you will see that not everybody made the same profit, but we took the same trade. And how do we explain that? That is because we use different lot sizes. Like I said, in simple terms, the lot size is used to measure the size of your trade. The size of your trade can be different from the size of my trade. My lot size can be bigger than your lot size, depending on maybe the account size I have, depending on how much I want to risk and how much I want to gain. My lot size will be different. Lot size 1 is bigger than lot size 0.1. Lot size 2 is bigger than lot size 1, right? We have different lot sizes. You get? So I'll take the definition once more. You follow up. I'll give you the complete definition now. A lot size refers to the number of currency unit being traded in a forex position. Or it is used to measure the size of your trade. Commonly expressed as a standard lot, a mini lot, or a micro lot. Commonly expressed as a standard lot, a mini lot, or a micro lot. I'll take it all over again one last time. A lot size refers to the number of currency unit being traded in a forex position, or it is used to measure the size of your trade. Commonly expressed as a standard lot, comma, a mini lot or a micro lot. Commonly expressed as a standard lot, standard, standard lot, mini lot, micro, micro lot. Perfect. Now we come back to the standard lot. We come back now to the standard lot. Now we want to break down the different lot sizes. We come back to the standard lot. Standard lot is referred to as lot size 1. So I'll just put equals to 1. Standard lot is referred to as lot size 1, which is equals to $10 per pip. I'm writing this one down now because some people might be confused. You're just going to take it down this way. I saw lot size 5 today. Please, any explanation? I'm getting to that. We are going to understand that very soon. Standard lot. Standard lot. Standard lot is often referred to as lot size 1. One standard lot. So it is expressed as lot size 1. So if I tell you that you are using a standard lot, then you are using standard lot size 1. And this lot size 1, if you use this lot size 1, if the market move your direction 1 pip, you will be making $10. Remember what is a pip? That was why I asked, have we all understood what a pip is? Standard lot, it refers to as lot size 1, and 1 pip, and 1 pip using a 1 standard lot will give you $10. Mini lot is often referred to as lot size 0.1, which is equals to $1 per pip. $1 per pip. Micro lot. Micro lot is also often referred to as lot size 0.01, which is equals to 10 cents. 10 cents per pip. I'll give you 1 minute to first of all copy what is on your screen. I'll give you 1 minute to copy what's on your screen, then I'll explain, I'll elaborate. 1 minute to copy what's on your screen, then I'll elaborate. Okay, now let's elaborate. Let's elaborate. Okay, I said 1 standard lot is referred to as lot size 1. one standard lot refers to as lot size 1. Does that mean that we have only one standard lot? No. We have 2 standard lot, 3 standard lot, 4 standard lot, 5 standard lot, and it continues 10, 20, and it goes up. You can use any lot size. Nothing is showing on the screen. Okay, let me stop and share again. Let me stop and share again. Okay, can you all see my screen? Let me see. Let me share the screen. Okay, I want to share the screen now. Can you guys see my screen? Yeah, Benny, share, yeah. Okay, now. Let me work on that. Let me figure it out. Let me figure it out. I want to share my. Good to go now. Good. Okay. Okay. Can you guys see my screen now? If it's not visible enough, then your network is disturbing. So I'll explain lot size. Let's go. One standard lot is referred to as lot size 1. That does not mean that we have just one standard lot. We have from lot size 1, lot size 2, lot size 3, lot size 4, and it goes up, right? But now it's very easy for you to do the math. If one standard lot, 1 pip movement is equal to $10, it therefore means that 2 standard lot, 1 pip movement will be $20. 3 standard lot, 1 pip movement will be $30. So if trader A, let's say we have trader A and trader B. You see I draw on my screen. Okay. Let's say we have trader A and trader B, right? Trader A uses lot size 1 to open a trade. Let's say this was a trade here. Trader A opens a trade from here and the trade moves right up to this level. The trade has moved 10 pips. If trader A was using lot size 1, that is one standard lot. If trader A was using one standard lot, how much would trader A make on a 10 pip movement? It's a question. If trader A is using one standard lot. One standard lot, that's one pip movement is $10. Trader A takes a trade from here, from point A here to. I hope this $100 you are giving, it is for calculation. You are not what others have said. Just to make sure you understand. Okay, maybe that question was easy. I'll go like this. What if trader B took this same trade, 10 pip movement, but trader B used the mini lot 0.1? How much would trader B make? Trader B uses a mini lot. Okay, now the screen that was show but the illustration need to show. Yeah. Okay, my illustration is not showing. My illustration is not showing. Let me figure this out. Stop sharing. Okay, if you see my writing. Yes, writing. Right over screen. Okay, let me. Notepad. I want to draw. Notepad. Go. Let me. Okay. So that is seeing what I'm doing here. I see a lot of mixed answers for the second question. Now let me figure out sharing my screen very well so that I actually explain for you guys to understand. You know, see our second day using using this YouTube, so it can be a little bit crazy to actually understand. Okay. Let's use Notepad. This point I'm going to share on my entire screen, and that entire screen is going to be disturbing. I want to know. I need to get some software we use like a workspace now. Okay, can we see my screen? Can we see my screen now, please? Can we see my notepad now? Okay, I think we can all see my notepad. So we said standard. Standard one pip is referred to as lot size one. One pip movement, $10 per pip. And we said mini is reversed to as 0.1, which is equals to $1 per pip. Then we have the micro, which is refers to as 0.01, which is equals to 10 cents per pip. Okay, I'll explain this. We have taken long too much on this particular topic. Now let me explain this right here. If we have two traders, trader A and trader B, if trader A places a trade, right, and uses lot size 1, trader A uses lot size 1, and the market moves 10 pips. Let's just say trader A and trader B, the market move both 10 pips for them. Trader B, right? So both of them, the market is moving 10 pips. They took the same trade. The market moved 10 pips to their direction. But now trader A was using lot size 1. Lot size 1, and trader B used lot size 0.1. The question is, how much would trader A make? You guys get me $100. And why would trader A make $100? Trader A will make $100 because if the market moves 10 pips to trader A favor, 1 pip using a lot size 1 pip movement is $10. So if 1 pip movement is $10, if the market moves 10 pips, then trader A is going to make $100. You get? So it's basically 1 pip movement on a 1 lot size is $10. So if you move 10 pips, it is that $10 times 10. Now come now to trader B. Trader B took the same trade trader A took, but trader B used lot size 0.1. So lot size 0.1, 1 pip movement is how much? Lot size 0.1, 1 pip movement is how much? Let me see in the comment section. $1, right? So if 1 pip movement is $1 on a 0.1 lot, that's a mini lot, how much will trader B be making on a 10 pip movement? On a 10 pip movement, trader B will make $10, while trader A make $100. That explains why the signal we sent today, a lot of people were sending different profits. Some people send even $1,000, some people send $10, some people send $100, $200, because our lot sizes we use are different. Now, let's say you want to use, let's say we have trader C. We have trader C uses lot size 0.01. So if trader C use 0.01, how much will trader C make? Most of you will be confused now because you don't even know how many cents will make $1. 10 cents times 10 will give you $1. 10, 20, 30, 40, 50, 60, 70, 80, 90. Then it gets now to $1. So trader C will make $1. Now pay attention to this next question. What if trader D uses lot size 0.7 on the same 10 pip movement? How much will trader D make? If trader D uses lot size 0.7, how much should trader D make? Let's see. Some people are getting it wrong. Lot size 0.7, lot size 0.1, one pip movement is $1. So the market move 10 pips, you make $10. Lot size 0.7, one pip movement will be $7. Lot size 0.7 is simply 0.17 times now. So we are going to be making 70. One last question, and we close for lot size. What if trader E use lot size? Let me see if I can confuse you guys. 1.7. How much would trader E be making? Lot size 1.7. Mathematicians will get it. Lot size 1.7 is simply lot size 1 plus lot size 0.7. So on the lot size 0.7, on a lot size on a lot size of 1.7, one pip movement will be $17. So if the market move 10 pips to trader E's direction, it will be $17 times 10. $17 times 10. Okay, based off what I see on the comment section, I think we have understood lot size, right? Have we understood lot size? If you have understood lot size, drop a fire. Let me see that fire. If you have understood lot size. Those who have understood lot size and have understood pips, drop double fire. Those who have understood lot size and have understood pips. If you have understood lot size and you have understood pips, drop double fire. Okay, those who have not understood, like I said yesterday, we all have different IQs. We all probably have different walks of life. Maybe you just came back from work, you are tired. Maybe you have been in the market the whole day with noise on your head. Maybe you are just come back from school, you have read, you are tired. That's why probably you are not understanding. That's why maybe it's taking you a lot of time to understand, right? That is why this session is being recorded. So you can go through the recording maybe when you have rest, or maybe when you are in a better position, right? Some of you, maybe as we are speaking now, you are going through heartbreak. You probably will not be understanding this thing now. But when your mind is settled, go through the recordings, right? You go through the recordings so that you understand better. Let's go now to the next key concept, leverage. Next key concept, leverage. Is it not possible for heartbreak to distract you on a new thing? Heartbreak will take away your mind. You will not be here. You'll be speaking here, you'll be thinking about your sweetheart. Okay, back to class. Leverage. Leverage. We started talking about leverage yesterday. Under why we should trade forex, we said the brokers give us leverage and it is an added advantage. Now let's look at leverage detailedly. Leverage. It is a use of borrowed capital. It is a use of borrowed capital. It is a use of borrowed capital to increase one's buying power in the forex market. It is the use of borrowed capital to increase one's buying power in the forex market. Leverage. It is a use of borrowed capital to increase one's buying power in the forex market. It is a use of borrowed capital to increase one's buying power in the forex market. I'm going to explain that. Don't bother. Leverage. It is a use of borrowed capital to increase one's buying power in the forex market. To increase one's buying power in the forex market. Now, how is leverage like? We have looked at lot size, right? We have looked at different lot sizes. Now, if you have a small money in your account, you might not be able to open lot size 1, where 1 pip movement is $10. If you have maybe, let's say $50 in your account, you might not be able to open lot size 1. You will not have the opportunity to open lot size 1. So you not have the opportunity to make maybe $100 in 10 pips movement. But somebody who has leverage might be able to open lot size 1. So what is the advantage? The advantage there is that it increases your buying power. Leverage increases your buying power. You get? You are going to see this leverage when you want to create accounts. When you want to create your account, they are going to ask you leverage. Which leverage are you going to choose? These leverage are often expressed in this format. Leverage are often expressed as in leverage. Leverage is always expressed as 1:100. It might be 1:50. It might be 1:1000. And XNES, which is the broker we are going to be using, offers 1:unlimited. One of the only brokers that offer 1:unlimited. Now, what does this mean? This means that with this 1:100, it therefore means that this 1 is representing what you have in your account. You get? 1 is representing what you have in your account. Is to 100, meaning that you can make 100 times what you have in your account. Please, let's pay attention, keen attention. 1:50. What does this 1:50 mean? This 1 represents what you have in your account, what you have deposited in your account. You might have deposited $50. You might have deposited $100. You might have deposited $1,000. That 1 represents what you have deposited. Is 2 represents how many times you can make. You get? So 1:1000, meaning that with 1 of what you have deposited in your account, that is maybe $100, $200, or $300, you can make 1,000 times. That's why you see at times like tomorrow we are going to be trading CPI. Probably I'll be trading CPI live if I have the chance. live on this YouTube. So inform your friends. If we are trading CPI, I could take $100 to $1,000. I could take $200 to $2,000 within a shortest period of time. Why? Because I am utilizing leverage and using big lot size. Right? So, if I have a leverage of 1 is to unlimited, it means that what I have in my account, I can make any amount I want. 1 is to unlimited means that you will open any lot size they will accept, no matter how much you have in your account. Why leverage like 1 is to 50 is going to have limitation. 1 is to 50, you cannot open a huge lot size if you have a leverage of 1 is to 50. So we are going to look at trader A and trader B here again. If we have trader A using a leverage of 1 is to 100 even. 1 is to 100. While we have trader B using a leverage of 1 is to 1,000. These two people can make two different profits, and as well as they can make two different losses. You get? These two people can make two different losses, as well as they can make two different profits. Trader A right here with 1 is to 1,000 might be able to open the highest lot size. You'll be able to open maybe lot size, let's say lot size 0.1. Why trader B with a leverage of 1 is to 1,000 might have the chance to open lot size 1. Might have the chance to open lot size 1. You get? So at this point, trader A could not open lot size 1 because the leverage he is using is small. Why trader B could open lot size 1 because the leverage he is using is big. So if the market moves to that direction, 10 pips, trader A is going to make just $10, while trader B is going to make 1,000 or $100, right? Trader B is going to make $100. That's if the market moves to that direction, 10 pips. So in this case, leverage has helped trader B make more money, right? Leverage has helped trader B make more money than trader A. But like I said yesterday, the leverage is a two-way sword. Leverage is a two-way sword. Leverage is a two-way sword. If the market actually went against them, trader A and trader B, if the market actually went against them, 10 pips, trader A now on the other hand will lose just the same $10. Why trader B that was using a big lot size, because leverage was able to permit him to use lot size 1, he will lose $100. We see that. Is that clear? Can we all see that? So a leverage is a two-way sword. A leverage is a two-way sword. Now, knowing when to use a leverage, we are going to look at that as we go ahead in the future. Maybe doing fundamentals, where you know that the market is not going to retrace, you can utilize leverage and go full margin. But on a normal scale, a good trader using proper risk management, you are not going to use leverage. You get? If you are trading using proper risk management, you don't need a big leverage. So for now, to conclude on leverage, Leverage increases your buying power in the market. Leverage is a two-way sword. It could be to your favor as well as it could be against you. And I have explained how leverage could be to your favor as well as leverage could be against you. I hope you have understood that point. If you have not understood that point, I believe you must be tired or you have something going on. You should come back and go through the video again. There's no crime in going through these recordings over and over and over. Let's go now to the next key concept: long and short position. Long and short position. Long and short position. Now I'll just share my screen now. Long and short position, that's the next concept we are looking at. Okay, look at my screen right here. Long and short position is very simple. Long position, long or short position. Long or short position refers to your expectation of the market. Refers to your expectation. Long or short position refers to your expectation of the market. Refers to your expectation of the market. Long or short position refers to your expectation of the market. It's simple. When we say we are going long in the market, what does that mean? Long. It means we are pushing to the upside, right? It means we are anticipating a buy to the upside. We are anticipating the market to buy. We are anticipating the market to buy, right? To push up. When we say short position, we are anticipating the market to push to the downside. If I say go long on CAD JPY, this is CAD JPY which we are on now. Go long on CAD JPY. It means that you should buy, right? It means CAD JPY is going to push up. If we say go short, it means we should sell. CAD JPY is going to sell. As simple as that. The next, bull and bear market. Bull and bear market. Bull, B-U-L-L, and the bear, B-E-A-R. Bull and bear market. Bull and bear market. Let's take down the definition. A bull market refers to a positive outlook. A bull market refers to a positive outlook when the market appreciates. Bull means buy. A positive outlook. Whenever anything is positive, right, it buys, right? If USD is positive, it buys. If USD is negative, it sells. So the bull and the bear simply represent the outlook, right? The bull market represents a positive outlook of the market. Bull market, I'm expecting the market to buy. Some of you have heard of the bull run with crypto. Bull run. We are expecting the market to buy, right? We are expecting crypto to pump. So the bull is when you are expecting a positive outlook, when the market is about to appreciate. While a bear market is the opposite. Indicates a negative sentiment towards the market. A bear market indicates a negative sentiment towards the market. The bear market indicates a negative sentiment towards the market. When you're expecting the market to sell, right? You're expecting the market to fall. You're expecting USD to fall. What can cause USD to fall? War, unemployment, negative aspects, right? Negative aspects will cause the market to crash. Bearish market. So we say the market is bearish or the market is going to be bearish when we are expecting a negative outlook or a negative sentiment. I hope those points are clear. The next, stop loss order. Stop loss order. Stop loss order. Stop loss order. You have to round up very fast. We still have one more topic to go. Stop loss order. A stop loss order is a type of order. A stop loss order is a type of order used in trading to limit potential losses. A stop loss order is a type of order. A stop loss order. A stop loss order is a type of order used in trading to limit potential losses. Stop loss order is a type of order used in trading to limit potential losses. Stop loss order is a type of order used in trading potential losses. Now let me explain. Firstly, take down this last point under stop loss. Take down this last point under stop loss. Never trade without a stop loss. From the definition, you hear that stop loss order is a type of order used in trading to limit potential losses. So if it is used to limit potential losses, therefore, you should never trade without a stop loss. 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 Okay, let me explain the stop loss. Pay attention to our chart. Pay attention to this chart. Let's take for example, right? Let's take for example, we want to place a trade. And this trade we want to place a trade at this point. Right? We want to place a trade at this point. Good. We want to place a trade at this point. You see that? Now, placing a trade at this point, which type of trade do we want to place? We want to place a buy trade. We want to place a buy trade. We want to place a trade for the market to buy to the upside, right? We want to place a trade for the market to buy to the upside. At this point, if you buy at this point and the market instead sells, what happens? You are losing, right? So if you are placing a buy here, a stop loss is used to limit potential losses, meaning that you have to place a stop loss below your buy order, so that if the market has to come and break, if the market has to break this point to push downward, right, then you are going to get stopped out automatically. The stop loss will automatically close your trade and you will be out. You get? So once you place a stop loss, let's say we place a stop loss here. This is our stop loss. Let me put the stop loss in green. Or let me put it in red. Because when your trade hits the stop loss, what you see is red. This one really on is red. Okay, let me change to a different color. Let me just change to this color. Okay, pay attention. Let's say you place a buy trade at this point, right? You place a buy trade at this point, and your stop loss is down here. The stop loss is there to limit potential losses, meaning that when you place a trade for a buy to the upside, always have a stop loss below, so that if the market instead sells when you have instead placed a buy, the stop loss will automatically close the trade. You get? And same go for a sell. Let's say I want to place a sell trade at this point. I want to place a sell trade right here for the market to sell to the downside, right? I want to place a trade for the market to start selling from up here to down here. I'm going to put my stop loss up here. I'm going to have my stop loss up here, so that if I take a sell for the market to sell and go down, and the market instead start buying, what happens? The stop loss is there to automatically close the trade, and I'll be out with small losses. So stop loss is used to limit potential losses. I hope that point is good. And stop loss also has its brother. Take profit. That's the next key concept. Take profit. Take profit. Take profit. If it is not clear, you can come back to the recordings later on. Take profit. Take profit order take profit order is an order placed to close potential profit. Take profit order is an order placed to close potential profit when price rises and reach a particular point. Take profit order is an order placed to close potential profit. Take profit order is an order placed to close potential profit. Take profit order is an order placed to close potential profit. Take profit order is an order placed to close potential profit when price rises and reach a particular point. I'll take it the last time. Take profit order placed to close potential profit when price rise and reach a particular point. Now I'll explain take profit. Unlike stop loss, which limits losses, take profit is there to close your profit. That is, when you are in profit, it helps you close. Because the market could go up and you are in profit. If you are not there to close, the market will go back down. So you could leave from your entry. Let's say you place a buy. We'll use the same scenarios again. Let's say we place a buy at this point. Right? We place a buy at this point, and the market is pushing upward. If the market push upward and reach a certain level, and you don't have a take profit, the market can start going down. Now, there are particular levels in the market where you place your take profit, and there are particular levels in the market where you place your stop loss. I'll repeat. There are particular levels in the market where you place your take profit, and there are particular levels in the market where you place your stop loss. These levels now you are going to understand them where we get to technical analysis, actually understanding and analyzing the chart. But for now, you need to know what it's all about. Take profit. Take profit is there to close potential profit. So if you place a buy from here and the market goes up, right? If the market goes up, you reach a certain level, there are levels of rejection. If you reach a certain level of rejection and your take profit is not, the market will start going back down. Maybe you were up here $100 in profit, but because you are not there to close, the market start going back down. As the market start going back down, you start losing back that $100 to 80, to 90, to 70. If you come back to your entry now, you'll be back at 0. If you leave your entry now and continues back against you now, it goes now and hit your stop loss, and you enter closing losses. You get? So take profit and stop loss is very important. Most importantly, stop loss. Without any stop loss, you can blow your account. The market will go against you $10, $20, minus 30, minus 40, minus 50. If your account was $100, you continue to you reach minus 100, then you are out of the market. That takes us now to margin. Next key concept, margin. Next key concept, margin. What is a margin? In forex trading, a margin is the amount of money a trader must put up in order to open and hold a position. In forex trading, a margin is the amount of money a trader must deposit in order to open and hold a position. Margin, I'll take it one last time. In forex trading, a margin is the amount of money a trader must put up in order to open and hold a position. Now, if you don't have money in your trading account, you cannot open a position. If you don't have money in your trading account, you cannot trade, right? So that money in your account is called margin. That money in your account is called margin. We have the used margin, free margin, and margin call. We have the used margin, free margin, and margin call. Used margin, free margin, and margin call. Now, what is a used margin? Used margin is when you have used some of your capital. Let's say you deposited $100 into your account. With that $100 in your account, if you have lost or you are losing $10 or $20, that therefore means that your used margin is $10 or $20. And if your used margin is $20, how much will be left on that $100? $80. That $80 now is your free margin, the one that has not been used. That is your free margin. You get. And with your free margin, you can still use it. You can still open more positions to use your free margin. Then margin call is when you have utilized all the money in your account. That's when you have blown your account. You see, we say you have margin call. You had $100. The market has gone against you. $20, $30, $40, $80, $90, and finally $100. You don't have any money again. All your money is finished in your account. That is margin call. For you to avoid margin call, you need to use risk management. Always have a stop loss. When there's a stop loss, if the trade is going against you, you can take maybe just only $10 or maybe only $5, right? So you use only $5 or $10 of your money. But if there's no stop loss, you're going to go until you finally take all your money. Is that clear? If we have understood these key concepts, drop the fire. Let me see before we go to the next session, to the next topic. If you have understood the key concepts, we all have understood the key concept, right? Perfect. Let's go now to lesson 4, the Forex price code. We can finish this lesson 4 in 5 minutes, as well as we can take the next 30 minutes. You can understand the Forex price code in the next 5 minutes if you are concentrated, as well as it might take you long. Before we get to the Forex price code, please thumbs up. Just give the thumbs up. The thumbs up is on your screen. Just give the thumbs up. If you're actually enjoying the lesson and actually following up the lesson, just give the thumbs up. And please subscribe. Subscribe to our YouTube channel. Let's take this 1 minute to do that. Thumbs up, guys. I don't mean thumbs up on comment section, oh. Thumbs up on the YouTube channel. There's a place there for you to like the YouTube. Thumbs up. I have 363 people have given me thumbs up. But we are about 800 and something people on this live. Let's get a thumbs up, guys. Thank you guys. Thumbs up and we subscribe. Stretch your body. Breathe in and breathe out before we get to lesson 4. Stretch your body, breathe in and breathe out. Ooh. You guys should thank God for Amy in the comment section. That is taking it over for you guys. I see how some people are begging. Please take it over from this when we had already passed. Anyways, Let's get now to lesson 4, the Forex price code. The Forex price code. Okay. We should be done with the Forex price code within the next 10 minutes. It's as easy as possible to understand, though a little bit complicated, but we can get it. Lesson 4. The Forex price code. Let's stay on this short note on the Forex price code. The Forex price code, simply break down the different currency pairs. The Forex price code simply break down the different currency pairs. The Forex price code simply break down the different currency pairs. The Forex price code simply break down the different currency pairs. Such that we are able to know which particular currency is moving the chart in a particular pair. The Forex price code simply break down the different currency pairs such that we are able to know which particular currency is moving the chart on a particular pair. Remember, we are trading in pairs. Examples of these pairs, we are going to use an example. I'm not sharing my screen. Stop sharing. Share. I want to share, but this. Perfect. The Forex price code break down the different currency pairs so that we are able to know which particular currency is moving the chart on a particular currency pair. For example, we use GBP USD. For example, GBP USD. So let's say this is one pair we are trading, right? We are trading this pair, GBP USD. If you are trading GBP USD, these are two different currencies of different economies on one pair. But looking at our chart, the chart is either buying and going up or selling and going down. The chart is either buying and going up or selling and going down. So if we have two different currencies, GBP, that's Great British Pounds, versus the United States dollars, that gives us the pair GBP USD. But on the chart of GBP USD, the market is either just going up or just going down. It's not going up and down. What does that mean? Does that mean that it is GBP that is buying or it is USD that is buying? Let's say the chart is buying. Let's say, for example, GBP USD is buying, right? If GBP USD is buying, does that mean that it is GBP that is buying or USD that is buying? Let me share my screen. Let me actually go to my actual chart so that we can work with real-time examples. Let me go back to the chart. Let's go back to the chart. So we're on the chart here, and we're looking at GBP USD. So I'll go to GBP USD. This is the chart on GBP USD. Why is it not opening? Let me insert back GBP USD. GU. That's GBP USD. I'm going to teach you guys how to navigate these platforms. That's what we are going to be doing tomorrow. How to navigate the platform. Okay, this is GBP USD, right? I've opened this chart. This is GBP USD. Now, looking at this chart, you can look at it down here. GBP USD. Now, on this chart, I can see that GBP USD has been on a downtrend. From up here, it has been going down, though it has started going back up now, but it has been on a downtrend. So on this particular pair, GBP USD, why it was going down, what does that mean? Is it GBP that is selling, or is USD that is selling? Because we have GBP USD here, right? Now let's take down this point. Let's take down this point. Very important point. The chart, that's this chart we see here, and every other chart you will open, every other pair you will open. The chart move based off the base currency. And I've told you guys to avoid the comment section, because I see a lot of people already giving me answers ahead, which means that they already know this topic. All students, people should stop prognosing. When you do that, those who are new now, they become confused. The chart move based off the base student. Sorry. The chart move based off the base currency. 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 Meaning that on every currency pair, we are always going to have the base and the code currency. On every currency pair, we are always going to have the base and the code currency. So on every currency pair, we are always going to have the base and the code currency, right? Right here, we have GBP USD. On this GBP USD, the base currency is the currency in front, and the code currency is the one behind. The chart move based off the base currency, a very important point. The chart move based off the base currency. The chart move based off the base currency. So if the chart is moving based off the base currency, right? Therefore, the base currency here is GBP, because all the currency pairs that are in front are the base currencies, while the ones that are behind are the code currencies. We should have drawn something like this. Something like this. Oh shit. Yeah, I have to start using trading view. because of this. I don't easily write on my screen. Okay. Have something like this in your books. Have something like this in your books. We have GBPUSD. Does not come out. Ah. Why is the text not showing? Whoa, whoa, whoa. Okay, just understand what I'm trying to do here, right? At this point, you want to type GBPUSD. I don't know why it's not changing. So you should type GBPUSD here. Okay. GBPUSD. I'm used to using this mostly on TradingView. Okay, that's it. GBPUSD. Then now when you type GBPUSD, which one is the base currency? GBP is the base currency, USD is the code currency, and it applies for every other pair. So any pair you open, you are going to have two currencies involved. The first one being the base currency, the second one being the code currency. And I've said this chart moves based off the base currency. What does that mean? It means that if you open this chart and it's selling, it means that GBP is selling. And if GBP is selling, we'll go back to the definition of forex trading: simultaneous buying of one currency and selling of another. If GBP is selling, therefore USD is buying. If GBP is selling, therefore USD is buying. So if you open any pair, for now, we have not looked at these pairs. The next lesson is going to be lesson 5, brokers and trading platforms. We'll start manipulating these platforms. When you get to this platform, you are going to see these pairs. You are going to see these pairs. If I can go now to the next pair, we have USD CAD. This was the one we were illustrating with. USD CAD JPY, right? What we have here is CAD JPY. So CAD JPY, Canadian dollars versus Japanese yen. Which one is the base currency? Which is the base currency? GBP was the base currency in the other one. Now CAD is the base currency because it is the one in front, right? CAD is the base currency. And now the chart move based off the base currency. The chart move based off the base currency, which therefore means that looking at this chart has been buying. This chart has been pushing to the upside. What does that mean? This chart has been buying from down here. It has been buying. What does that mean? It means that CAD is buying. And if CAD is buying, what happens to JPY? JPY is going to be selling. Is that understood? If CAD is buying, JPY is going to be selling. The definition of forex trading: simultaneous buying of one and selling of another. So if this one is buying, this one is selling. Is that understood? Now I'll give this last explanation before we go. Tomorrow we have CPI. Consumers Price Index. It's a news event based in the US. This news event affects USD. It's a positive news. If consumers price index is high, then it's going to be positive for USD. Pay attention. If consumers price index for tomorrow is high, then it's going to be positive for USD. Now, if it's going to be positive for USD, will you be buying or selling GBP USD? Remember again that the chart moves based off the base currency. So right here, GBP is the base currency and USD is the code currency. And I said if GBP, USD will buy. If USD is buying, GBP will sell. Now we want to take this example. CPI tomorrow. If CPI tomorrow comes out and USD gains strength, USD gains strength, meaning that USD goes up. If USD goes up tomorrow, right? What is going to be the outcome? USD buys, right? If USD buy, what is going to be the outcome on GBP USD? Will you buy or sell? Please, to the new students, most important. If you are an old student, I already know this thing. No need for you to answer. I want to know. I want to make sure that those who are new are understanding. So if we have USD buying tomorrow, that is, there's a positive news for USD, right? Positive, it might be employment. If the level of employment increase in the US, USD will gain its strength and USD will be buying. The same like when Donald Trump won election, USD gained its strength, USD was buying. But you as a trader, you are not going to be trading USD. You are going to be trading a pair that has USD. Because as a forex trader, you trade currency pairs and not currencies. So you analyze that currency and you see that USD, which is a currency, is buying. Will you buy or sell GBP USD? I will give you the answer and I will explain. Then I'll look for a different pair and I ask the question again. You will be selling GBP USD as a pair. Why? Because USD is buying. And if USD is buying, automatically GBP has to sell. GBP has to sell. Because the two cannot buy at the same time. USD cannot be buying and GBP is buying. No. If USD is buying, GBP will be selling. So on this chart, GBP USD, we are going to be selling GBP USD. Why? We will be selling GBP USD because GBP is the base currency. And if USD, which is the code currency, is selling, therefore GBP is going to be selling. And since the chart moved based off the base currency, the sentence, the important point I told you guys to take note of, the chart moved based off the base currency. So if USD is buying and pushing GBP down, therefore GBP being the base currency, this chart is going to sell. Now I'll ask this one last question. We are going to go now to USD JPY. USD JPY is not opening. But let's say we had USD JPY now. Let's say we had USD JPY. USD JPY is not opening. Let's go to USD CHF. Oh, they're not opening. Okay, let me open a different pair. Let me open USD CHF. Now this is USD CHF. USD Switzerland francs, right? On USD Switzerland francs, USD CHF. Why is it that small? Let me make it to be big so we all can see. Put it yellow. Give it 20 size. Okay, USD CHF. We are going to use the same example. Let's say CPI for tomorrow comes out positive for USD, right? So USD is going to be buying. USD to buy. So if USD is going to be buying, what are we going to do on USD CHF? What are we going to do on USD CHF if USD is buying? What are we going to do on USD CHF if USD is buying? Are we going to buy or sell? Well, a majority says we will buy, but I still get a lot of people saying we will sell. How will we sell when USD is going to buy? USD is going to buy. Let me go over this thing again. USD right here is buying. So you want to come and apply to the chart now. You are trading USD CHF. If USD is buying, is USD the base currency or the code currency here? First question. USD is in front this time. Unlike the other time where USD, GBP USD, unlike GBP USD. Okay, let me write GBP USD here. Maybe you guys are just confused. Let me put now here GBP USD. GBP USD. Okay, we have USD CHF and GBP USD. On GBP USD, if USD is going to buy, then we'll be selling GBP USD. That was the first example we had, right? Why will we be selling GBP USD? Because GBP is the base currency, USD is the code currency. And if USD is buying, it therefore means that USD here is buying. If USD is buying, GBP is going to sell. GBP here is going to sell. And the chart move based off the base currency, which therefore means that this chart on GBP USD is going to be selling generally, even though it has USD that is buying. The chart GBP USD will be selling because the chart move based off the base currency. And which one is the base currency? GBP. And now I come to this other example just so that you understand. Now on this other example, now we have USD now instead as base currency. But would this buy on USD still affect USD CHF? Yes, it's going to affect all pairs that have USD. Now you need to differentiate to know when you are going to buy or when you are going to sell, the pair you buy or the pair you will sell. So on USD CHF now, USD CHF, we are buying USD. So this particular USD here now is the base currency and the chart move based off the base currency. So since the chart move based off the base currency, which is USD, and USD is buying, we are going to buy this pair, USD CHF. Because if USD is buying, CHF is going to drop. But we cannot sell this USD CHF now, my people. Those who are selling, sell. We cannot sell USD CHF because USD here is instead the base. USD is instead the base. And since the chart move up the base currency, we are going to be buying. Is that understood? Is that point understood? Perfect. If that point is understood, then that is it for the Forex price code. If you have not understood, like I've said, that is why this session is being recorded. Go through the recordings. Immediately I'm going to stop this live stream. is going to be on YouTube. I'll send the link to Telegram. Go through the link on Telegram, share to your friends. Those who are joining today, please go to Telegram or just go to the YouTube. You're going to see the lesson session for yesterday, lesson 1 and lesson 2. Go through again. Then you come back to the lesson of today, lesson 3 and lesson 4. You go through again. You get. Try to understand. If you want to understand, you will understand. If you are not understanding and you really want to understand, you will understand. Remember, the support team is there to answer your questions. Contact the support team and answer your questions. Contact the support team. The support team is going to answer your questions. I'm going to drop the communication channel in the main Telegram now. So I'll drop the communication channel in the main Telegram now. So in the communication channel, please, the communication channel is strictly for you guys to ask questions. So that if one person asks a question, when an answer is given, maybe many people had that same question, they are going to be able to learn from that question. No unnecessary discussions in the group, because unnecessary discussions is going to overcrowd the group and valuable lessons will not be able to, people will not be able to figure out the valuable lessons, right? So I'm going to send the group link to Telegram now so you can join. It has a section for problems. If you have a problem, you go to that section. It has a general section, general communication. Then it has results that you can always post your results, right? Later on. So I'm going to send to Telegram, our main Telegram now. You join from there, right? Join the discussion forum. Okay, so I've sent the link on Telegram. So go join. Like I've said, tomorrow we are going to start with creating trading accounts. We are going to start with creating trading accounts. So this night, I will send a link on how to create your account. I'll send a video, right? I'll send a video on how to create your account this night. You can do that anytime, maybe this night or tomorrow. But that's what we are going to do tomorrow. Tomorrow we'll elaborate more on it. Tomorrow we are going to elaborate more on it, right? So for today, we have covered lesson 3 and lesson 4. Tomorrow we will cover lesson 5, brokers and trading platforms. Starting from this night, right? Starting from this night, I'll send a link for you to create your trading account. Click the link, create your trading account, fill in your right information. Sorry. Fill in your right information, right? You are filling your information as on your ID card, please, because you have to verify your account with your ID. Now, if you have the carton ID which is not clear, to save yourself the stress, take your close family member, your mom, your dad, your sister, take their ID card and use. But if you have your original ID card, use your original ID card. When you create your account, you're going to verify your account, upload your ID card. You're going to be asked a proof of residence, right? If you're asked a proof of residence, if you have that new ID card that has that address behind, snap the back of your ID and submit. To some people they'll accept, to some people they will not accept. We are going to have a lot of problems with verifying the account. You will need a proof of residence from the council, or a utility bill either in your or Kamwata, or you are going to need a bank statement that has your address. They just want to verify to make sure you're in Cameroon. Now, the link I will be sending are for those who are in Cameroon, those who are in the UAE, those who are in Europe, America, UK. You might not be able to create your accounts with that broker, right? So what you have to do is, I'll send a different broker for you to create. Please, those who are using Starlink, when you want to create your account, disconnect from your Starlink. If you are using VPN, when you want to create your account, disconnect from that VPN so it shows your location. You get? Because if you're using VPN or Starlink, you might not access the site because they'll be like, maybe you are in the US, whereas you are in Cameroon or in the UAE, right? So I'll send a link for creating of account. We'll still work on that tomorrow. As of today, I hope we are all on track, right? Are we all on track for today? Are we all strapped for today? So we can boldly say that lesson 1, lesson 2, lesson 3, lesson 4 are trashed, right? We can say that we have covered lesson 1, 2, 3, and 4. Are we good with that? Perfect. Are there Nigerians here? Nigerians, let me see your flag. Nigerians. Nigerians. Nigerians in the building, let me see your flag. That's massive. That's massive. That's massive. That's massive. I hope the ladies for yesterday, people have not given up. Nobody should give up. Oh. Though I see the numbers are dropping. Yesterday we were on 1,500 viewers. Today we went to 900, 1,000, dropping between 800, 700, 1,000. I hope we are not giving up on this. I'm trying as much as possible to explain until my breath can even cut. Just so you understand. Just so you don't give up. I try as much as possible to, use the simplest terms so that we can all understand, right? Okay, Canada here, America in the building, Germany, UAE. UAE is a lot. I know. All my people from Dubai. You guys are always active. Massive. I don't want to call Cameroon because if I call Cameroon, the place is going to be crowded. But yeah, thank you guys for joining. Thank you guys for joining. Like I've said, I'll give more instructions on creating of the accounts in the Telegram channel. So please, let's stay tuned. See you guys tomorrow. Peace out.